Portugal's banking dynasty falls from grace. For nearly a century and a half, the name Espírito Santo commanded reverence in Portuguese banking circles. Founded in 1869 by José Maria do Espírito Santo e Silva, what began as a modest financial house grew into Portugal's largest private bank and the cornerstone of a sprawling business empire. By 2014, Banco Espírito Santo held assets worth 42 billion euros, employed thousands across multiple continents, and counted among Europe's most established financial institutions. The Espírito Santo family had weathered 2 world wars, survived Portugal's authoritarian Estado Novo regime, and emerged triumphant during the nation's democratic transition. Their bank had become synonymous with Portuguese capitalism itself, a symbol of stability in a country still recovering from its own financial crisis. Yet beneath the marble facades of their Lisbon headquarters and the polished veneer of international respectability, a web of deceit, family infighting, and systematic fraud was about to bring down one of Europe's oldest banking dynasties in spectacular fashion. The warning signs began emerging in early 2014, though few outside the family's inner circle understood their significance. In January, Espírito Santo Financial Group, the holding company that controlled the bank, delayed publishing its annual accounts without explanation. This seemingly administrative hiccup would later be revealed as the first visible crack in a carefully constructed facade that had been hiding billions in bad loans, phantom assets, and off-balance sheet liabilities. The family patriarch, Ricardo Espírito Santo Silva Salgado, had built his reputation as a shrewd international banker who transformed his inherited regional institution into a global player. Under his leadership, the bank had expanded aggressively into emerging markets, particularly in Angola and Brazil, while diversifying into insurance, asset management, and private equity through a complex web of subsidiaries and affiliated companies. Salgado himself had become one of Portugal's most prominent businessmen, serving on the boards of major corporations and wielding considerable influence in political circles. His personal wealth was estimated at over 100 million euros, and he lived like European royalty with estates in Portugal, Switzerland, and London. The first public indication of serious trouble came in May 2014, when Rio Forte, a Luxembourg-based holding company controlled by the Espírito Santo family, missed a bond payment worth 89 million euros. This default sent shockwaves through European markets and prompted immediate scrutiny from Portuguese banking regulators. Within days, investigators discovered that Rio Forte was just one node in an impossibly complex corporate structure designed to obscure the true financial condition of the Espírito Santo empire. The family had created dozens of shell companies, special-purpose vehicles, and offshore entities across multiple jurisdictions, many of which existed primarily on paper. These entities had been used to move money between related parties, disguise losses, and inflate the apparent value of assets on the bank's balance sheet. More troubling still, investigators found evidence that the bank had been systematically lending money to these family-controlled entities without proper risk assessment or regulatory disclosure. In some cases, loans had been approved based on fabricated financial statements or collateral that existed only in accounting ledgers. As Portuguese banking authorities launched their investigation, the scope of the fraud became staggering. The bank had accumulated approximately 2 billion euros in exposure to family-related entities and high-risk investments that had been hidden from regulators and shareholders. Much of this exposure stemmed from the bank's aggressive expansion into Angola, where the Espírito Santo family had deep historical ties dating back to Portugal's colonial period. The bank had poured hundreds of millions of euros into Angolan ventures, many of which were controlled by politically connected individuals or companies with questionable business models. These investments had been presented to regulators as low-risk commercial banking activities, when in reality, they represented highly speculative bets on emerging market opportunities that were closely tied to the family's personal business interests. The bank had also been using creative accounting techniques to move problem loans between subsidiaries, temporarily removing them from regulatory oversight before cycling them back onto the main balance sheet in different forms. The complexity of the Espírito Santo financial web was matched only by the intensity of the family feuding that had been brewing behind closed doors for several years. Ricardo Salgado found himself increasingly at odds with other family members over the direction of the business and the distribution of control within the empire. His cousin, José Maria Ricciardi, had been pushing for greater transparency and risk management controls, arguing that the bank's aggressive growth strategy was endangering the family's century-old legacy. Meanwhile, Salgado's own children had begun questioning some of their father's investment decisions, particularly the heavy concentration of resources in African markets that they viewed as politically unstable and financially unreliable. These internal conflicts had paralyzed decision-making within the organization and prevented the implementation of reforms that might have prevented the eventual collapse. Family members had also been siphoning money from various entities for personal use, including luxury real estate purchases, yacht acquisitions, and private art collections, further weakening the financial foundation of the empire. By July 2014, the situation had deteriorated beyond repair. Portuguese banking regulators conducted stress tests that revealed the true extent of the bank's problems, including a capital shortfall of approximately 3 billion euros. The European Central Bank, which had recently assumed supervisory authority over major European banks, demanded immediate action to stabilize the institution. On July 20th, Ricardo Salgado was forced to resign as chairman and chief executive, ending 40 years of family control over the bank. His departure triggered immediate panic among depositors, leading to the largest bank run in Portuguese history as customers rushed to withdraw their funds. Within 72 hours, the bank had lost nearly 2 billion euros in deposits, pushing it to the brink of immediate collapse. The Portuguese government, already struggling with its own debt crisis and operating under strict European Union austerity measures, faced the impossible choice of allowing a systemically important bank to fail or committing taxpayer resources to a bailout that would violate EU state aid rules. The resolution came in the form of one of the most complex banking restructurings in European history. On August 3, 2014, Portuguese authorities split Banco Espírito Santo into two separate entities through a process known as a bridge bank resolution. All good assets, deposits, and performing loans were transferred to a newly created institution called Novo Banco, which was immediately capitalized with 4.9 billion euros in public funds. The original bank was left with all the toxic assets, family-related loans, and problem investments, effectively creating a bad bank that would be liquidated over time. This solution protected depositors and maintained banking services while ensuring that shareholders and bondholders bore the losses from the family's mismanagement. The restructuring required approval from the European Commission and represented one of the first major tests of new EU banking resolution mechanisms that had been designed to prevent taxpayer bailouts of failed financial institutions. However, the complexity of the Espírito Santo corporate structure meant that the resolution process would take years to complete and would ultimately cost Portuguese taxpayers far more than initially estimated. The criminal investigation that followed revealed the full extent of the fraud and corruption that had brought down the banking dynasty. Portuguese prosecutors charged Ricardo Salgado with multiple counts of fraud, money laundering, and market manipulation, alleging that he had systematically misled regulators and investors about the bank's true financial condition. The investigation uncovered evidence that Salgado had personally benefited from fraudulent transactions worth tens of millions of euros, including the use of bank funds to purchase personal real estate and artwork. Other family members were also charged with various financial crimes, including his daughter, who had allegedly received improper loans to fund her own business ventures. The criminal case revealed that the fraud had been ongoing for at least 5 years, during which time the bank had consistently overstated its profits and understated its risks in communications with shareholders and regulators. Investigators also discovered that the bank had been paying bribes to Angolan officials in exchange for favorable treatment of its business interests, adding international corruption charges to the growing list of alleged crimes. The collapse of Banco Espírito Santo sent shockwaves far beyond Portugal's borders. highlighting weaknesses in European banking supervision and raising questions about the oversight of complex financial conglomerates. The bank's failure occurred just as the European Central Bank was assuming responsibility for supervising major European banks under the new banking union framework, creating an embarrassing crisis for regulators who had assured markets that such systemic failures were now impossible. The scandal also exposed the continued influence of family-controlled financial institutions in European markets, many of which operated under governance structures that prioritized family interests over shareholder protection or regulatory compliance. Credit rating agencies came under criticism for failing to detect the problems at Espírito Santo despite having regular access to the bank's financial information and management. The bank had maintained investment-grade ratings from major agencies until just weeks before its collapse, raising questions about the effectiveness of credit analysis in identifying fraud at complex financial institutions. The aftermath of the Espírito Santo collapse continues to reverberate through Portuguese society and European banking regulation more than a decade later. Ricardo Salgado was ultimately convicted on multiple fraud charges and sentenced to 6 years in prison, though he remained free pending appeals for several years due to his advanced age and health conditions. The resolution of Novo Banco proved far more expensive than originally anticipated, eventually requiring additional capital injections totaling nearly 8 billion euros in taxpayer funds. Portuguese authorities struggled for years to recover value from the toxic assets left in the bad bank, with investigations revealing that many of the underlying investments had been worthless from the moment they were created. The European Union responded to the crisis by strengthening banking supervision requirements and implementing new rules for the governance of family-controlled financial institutions. Today, the former headquarters of Banco Espírito Santo stands as a monument to one of Europe's most spectacular corporate failures, a reminder that even century-old institutions built on family legacies can collapse overnight when greed and fraud replace prudence and integrity. The Espírito Santo name, once synonymous with Portuguese banking excellence, has become a cautionary tale about the dangers of concentrated family control in systemically important financial institutions and the devastating consequences when personal interests override fiduciary responsibilities.